Hello guys, happy Thursday. How's everybody doing today?
Pretty good, and you?
Pretty good, pretty good.
Awesome.
So we're just gonna wait a couple minutes for people to join in. But while we're waiting, does anybody have questions? Okay, so happy Thursday, guys, for everybody who's joining. If anybody has any questions, please feel free to jump in. We're gonna get started in just a minute. I just want to let people join in for a minute. So yes, the LP360 training videos are in the back office. We're still working on getting the Thursday calls up into the back office. Hopefully that will be soonish. But yes, the original like run through the software and how do you run an appointment and all of that, that is already in the software. Okay, so I'm going to give it just one more minute to let people join because without fail, as soon as I start speaking, I've got like 12 more people that jump on. So we'll give it just one more minute and we will get started. I've got a couple of things I wanted to talk about today if nobody has any questions. If you do have questions, again, please feel free to jump in. I like to make sure that my trainings are as relevant and useful to you guys as possible. So now, while we're waiting, I'm just going to pull some stuff up. So again, if anybody has any questions, feel free to jump in. Okay, it is now 5 past, and I think we are going to just let people join as they join. So if anybody has any questions, please feel free to jump in. Otherwise, there were a couple of things I wanted to talk about today, questions that I did get this week that I figured other people might have questions about. So first things first, let me share my screen so you guys can see what I'm looking at. Okay, can everybody see my Foresters page? Yes, no, maybe? Okay, great. Thank you, Vince, for responding. So I am trying to check the chat, but if you guys are posting questions in the chat and I don't answer you within a couple of minutes, please feel free to jump in because of everything else I'm doing. That's one thing that usually gets neglected. So a question I got earlier this week is that people are not entirely sure how to make sure that as a person grows financially, how their bank will grow with them. So when you have a client and you have, let's say this kid is 25 years old, they're single, they are at their first real job out of college, and they're starting out in life, but they know that they're going to be getting a promotion in a year or so, and that will come with a significant raise. And they're trying to save right now, but they're concerned about whether they'll be able to do all of these things in the future that they have goals for. So when we're talking about building space, there's two things that we need to know. One, does this person have a lump sum that they are saving right now, or is it just a monthly payment? So for anybody out there, when you see clients that are, admit people. When you guys see clients and they are looking to start funding and start saving, do you find that most of your younger clients have a lump sum or just a monthly payment? Anybody? Okay, we'll do it both ways. It's fine. So, and guys, please feel free to participate. I hate talking to myself. So we're gonna come in. This is our illustration software.
Morning, Kendra.
Good morning, Andrew.
Good
How are
afternoon.
you?
Good, good, good. Yeah, I have a client. Do you want to run the illustration on that
Sure.
lump sum?
Let me refresh this. It's been really weird the last couple of days. So let's try this again. Advantage +2. Unable to run. Please review alert messages. Sorry, guys, bear with me just 1 second. We're going to log off. Click here to log in. Ah, that's why. Log in. Illustrations. Let's try this again. Awesome. Okay, so Andrew, is your client male or female?
Male.
Male, perfect. And how old are they?
Um,
Or do you know their birth date?
yeah. July 12, 78, 1978.
Perfect.
For
78. Okay, so I always run first things first, put in medical. And I always run them non-tobacco standard because if they come back as preferred or preferred plus, more is the better. You can always hand great news to your clients and be like, oh yeah, by the way, you'll have more money. But it's a little bit tougher when you show them a preferred or preferred plus illustration to go back and be like, actually, you're only standard. So always under promise, over deliver. So we're going to the death benefit and funding. So I use the FPUA permanent term blend non-mech face solve.
Oh, and also it's in California, not Colorado.
That's fine. You know,
Oh.
if let me see if I can change it on this page. Oh, I can. California. Yeah, so when you're running illustrations, make sure that you're running them for the right state, because it's actually illegal to show them an illustration that is not for their state. But for the purposes of a life insurance illustration, it's not going to change the illustration, except that it won't be in the right state. So just good point. Thank you for pointing that out. I usually run it anywhere from like 65 to 70, excuse me, 80 at the highest. 70, 75 is usually where I like to stay. So we'll leave it right there for now. So Andrew, is this
You
client?
do 75? Can we do 65 and 35?
Yeah, we can do that.
Okay.
65 to 80 is in the window of what I use. It depends on what we're trying to achieve and whether or not we can achieve it. I adjust that as necessary. So usually 70, 75 is where is the ballpark of most clients, but 65 is perfectly reasonable. So how much is this person contributing?
Okay, so they put in 4,800 a year.
4,800 a year. Okay, let me grab my calculator. Are they paying annually?
Yep, they're paying annually.
That is awesome. So 4,800 a year. So that's what, $400 a month? Okay, perfect. Do they have a lump sum at all?
Yes.
Okay, perfect.
So he gonna take out 50,000 from crypto money and dumped it in. So I don't know how that.
Okay, so we have something called, why is my calculator? Oh, that's over there. Problems when you have 3 screens. Okay, so there's something called the premium deposit fund. It's the PDF. So we have $50,000 and we have a $4,800 annual contribution. So we're going to find out if that will even support it. But
Mm.
what the PDF does is it's a place to house premium until it gets automatically pulled into the policy itself. So our formula for this is that you can only have 2 years of premium inside the PDF. Therefore, what that means is to figure out the calculation is we take our lump sum, we subtract out our first year premium, and then whatever's left, we divide by 3 because we're paying annually. So we can put our first year premium all in the policy all at once. And then it's 2 years of total premium that can go into the PDF. So whatever that is, times 2 is what's left. So we're taking our $50,000. We're subtracting 4,800. That leaves us with 45,200, and we're dividing by 3.
And,
Enter.
and yeah, and Forrester said that the maximum they can put in, the client can dump in at one time is 200,000. That's the max.
Yes, but
Mhm.
there are other factors to consider
But
because we want to make
exactly.
sure that their annual premium
Income.
is still funding the policy. We don't want the death benefit to be eating away at their cash value, which is why we want to, when you have a huge gap like that from $50,000 to $5,000, we want to spread that out a little bit so that it is still supporting the cash value as well as the death benefit. Because I'm
Yep.
assuming that this client is looking to create a bank, yes?
Yes.
Okay.
Mhm.
So basically what we have is $15,100 a year. So right now their modal premium is $37.90 into the paid up additions rider, which is where the cash value lives. So $15,100 for years 1 through 3. Being dumb. Okay, let's see. Let's see what we've got here.
So you said
Okay.
what you got the 15,000 from?
So where we got the
Yeah, I'm
15,000 is
Mhm.
we take the $50,000, we
Mhm.
subtract our year 1 premium.
Mhm.
That leaves us with $45,200. We divide this by 3. So over 3 years, because we're paying the first year premium up front, and then we can put 2 years of premium into the PDF.
Okay.
Okay. So, and this has a couple of benefits, which I'll go over in a second.
What about his $50,000 interest that's drawing on the balance? Where is that 50,000 at? You got 50,000 going in, you're taking out 48. That's gonna leave you whatever. But now, is that balance on that 50 drawing interest?
Yes.
Where is it sitting? Is it sitting out there in limbo?
No, it's so that 50,000 or the 45,000 and change is sitting in what we call the premium deposit fund. So the premium deposit fund is a fund outside of the policy that you can.
Understood. Understood. Now, what
Yep.
kind of interest is that premium deposit paying?
I want to say it's around 1%. It's not fabulous. It's not like that money is inside the policy, but it's far better than a savings account. So there are numerous benefits to putting it into the premium deposit fund. It's not visible to FAFSA. It is better than a savings account. Because you're putting it in the premium deposit fund, you're now paying the policy annually. However, the client can continue to pay monthly. So basically the client can have a monthly draw of $400 going into the premium deposit fund, but then on the anniversary of the policy will pull from the premium deposit fund that $4,800 so that the policy pays annually, thus decreasing the actual cost basis of the death benefit, which overall increases your cash value faster over time.
Okay, is that contract going to show your illustration? Is it going to show a total of $50,000 put in the first year?
No, because it's not going into the policy the
Okay,
first year.
how is it going to be explained to the client? Where is it going to show on the illustration?
We're going to talk about that in 1 second.
Yeah,
Okay,
It'll be
Um,
easier when I show you the illustration.
yeah, Kendra,
Yep.
I apologize. I messed up on the client information because while I'm talking to you, I just jump on and try to pull it out from the Life Plan 360. So there's some correction.
Yep.
The birth date is actually September 27, 1980.
Oh, okay. Even better. 9/22/1980. More's the better.
Yep, and then it's not, that's the other guy. But anyway, I want to run this one is the monthly that he put in is 2,805 to be exact, a monthly.
2,800 monthly.
Yep, $2,805.
And is he still putting in the $50,000?
Yep, he got
Okay. That will,
$50,000.
yep. So
know.
2,800 monthly times 12
Correct.
is $33,600. Okay.
Mhm.
So 50,000 minus 33,600 enter is 16,400. Okay. So again, we're always going to, if they have a lump sum, the best thing for them is to pay annually. So we're going to take that lump sum and subtract out our first year premium. And
Mhm.
then if they want to continue paying monthly, they can do that now, but they get the added benefit of an annual premium, which decreases the cost basis of the death benefit. So it builds their cash value faster. So, this person is only 42. So are they concerned about having a lot of space?
Yes, you want to have space in between if you're gonna put more money in.
Do you know approximately how much money he might be expecting to be able to add? And when?
Yeah, he doesn't know when, but he would think he want to put at least safeguard like about 1,000 more a month.
Okay. So with a client like this, I might run a couple of illustrations. So for this,
So
I
we
think
would run the close.
16,000.
Uh-huh.
I'm sorry.
We run a like no space, and then we run one with
Oh no, you have
room.
space. You've got $50,000 that you need to figure out what to do with. So you've got an extra $16,400 that has to go into the policy somewhere. So
Right.
it's a matter of, are we dividing this by 2 years or by 3? So I would probably divide it by both and have both illustrations ready to show the client the benefits of each.
Okay.
And then they can make an informed decision of what they think their financial situation is going to be, because they will have a better understanding of where their future income is coming from to put into savings. Does that
Got it.
make sense?
Yep. Okay.
Okay. So first things first, I'm going to divide this by 2. So we're going to divide by 2. We've got $8,200. So we're going to go to death benefit and funding. So we said it was
600.
33,600. Thank you.
Mhm.
33,600 on an annual basis. We're coming over to riders. And what did I just say that was? It was $8,200. So
Mhm.
8,200 for years 1 and 2. Okay.
Mhm. And also what methods that you pick? I'm sorry, on the first one, on the client, when we
Going
just
over here.
yeah, you said medical, blah blah
Yep.
blah.
Medical, non-tobacco standard.
Um,
And then to build the illustration itself, if I come to death benefit and
oh
funding,
yeah, that
case
PUA.
design
Okay.
is FPUA, permanent term blend, non-mech face solve.
Can you drop down on that and see what other option do we have? Okay, yeah, okay.
Yeah, so if we have a bubble amount of money, a lump sum, if you will, this is the solve that I use. If we do not have that, there are other ways to create space, and we'll get to that in a minute.
Mhm.
So for this example, is he married? Does he have kids?
Nope.
No,
Yeah.
no kids.
Mhm.
He's still only 42 though. I still might put a 20-year term on this because
Mhm.
he is still a young man. And you know, he's theoretically going to want to protect somebody. In the case of God knows what. So I'm going to put a 20-year term on it, just
Okay.
for the sake of argument. So we're also going to drop down this maximum annual payment. So what we have here is $28,000 plus $8,000. So that's $36,000. So what I'm going to do here is I'm going to just say that the max annual amount that can go into the FPUA is 40.
Mhm.
Because that becomes part of underwriting. So you don't want that number to be too high and have it bounce.
Yep, okay.
So we're going to now go to at a glance. Okay, perfect. So Al, to answer your question, this is where right here, if you can see my cursor right here, is where that $50,000 is displayed. So we know that our annual premium is $33,600. So the extra $8,200 or $16,400 is split over 2 years and is going partially in year 1 and partially in year 2. So what this does is it automatically creates space for us for years 3 through 10 to add a whole lot more money, because he can add up to an additional $8,200 a year without turning the policy into a MEC, which we don't want to do because it would then become taxable. But it creates that space in here, and it still shows on the illustration. If the client asks, you can say, well, it's a lot to put all in year 1. So what we did was we gave you the added benefit of an annual funded policy, which means that the cost basis for the death benefit is less and it builds your cash value faster. So you've spread it out. So basically what the client needs to know for benefits to them is you have given them a lower cost basis for the death benefit. It builds cash value faster, and they now have space inside the policy such that they can add more money from years 3 through 10 if they so choose, without having to prove insurability and start another bank. We've just created space. Does this make sense?
Yep.
Okay. So we now have all of that space. Do you know approximately what he's making per year?
Let me see on his income here, 84,000.
Oh yeah, he's well within the underwriting limits. Which I pretty much assumed, considering he was able to save $2,800 a month. But for those of us who are a little bit less familiar with designing illustrations of this kind, the general rule of thumb is that 20 times their annual salary is their max insurability for year 1. So you said it was what, $84,000 times 20, $1.6 million would be pretty much the max of what underwriting would say, yes, this makes sense. If we were trying to insure this person for more than that amount, we would have to justify why we're doing it. And I've actually had clients that I had to justify why we were doing it because, you know, one spouse was an engineer, the other spouse was a teacher, but the engineer was uninsurable. So they were putting their entire family bank onto the teacher. So her salary would not support the death benefit for the entire bank. However, them being a unit, we would be able to get that past underwriting with all of this background information, because we're trying to accomplish a, protection for the family. We're trying to we're using this for a banking scenario. And even then there are still limits, but it is a conversation that you can have with underwriting. Definitely have a conversation with an underwriter. They are very, very helpful, very, very nice, and they can give you the rules of thumb and what documentation you need to provide. So
yeah, I have a case like father and son, kind of like the son is just like 20 years old, and then the father is uninsurable.
okay.
And then he tried to set up the bank using the son, but the son is still in school and just making barely like summer job or whatever art job that he's taking, so the income is not there. So you think they'll look at like father and son case or
Does he have any other children?
nope, one son.
Just one child?
Mm-hmm.
Okay, definitely give underwriting a call and tell them what the situation is and what they're trying to accomplish. And they will tell you what they need to see in terms of documentation. How do we know that he's uninsurable? What is he trying to do? They very well might consider his income because they are a family unit. And the child is of age at this point. So putting a PUA on them is not going to be a problem. If the child was a minor, it would definitely be a problem because you can't put a paid up additions rider on anyone under 18. So definitely give underwriting a call and have as many facts and as much information as you possibly can to do just an informal underwriting on it to see what they require.
Yeah,
but there's a lot more flexibility when you have documentation for things and you have real conversations, and they can give you real-time advice on what you need to do and how you can best assist your clients.
Great.
Does that make sense? Okay,
Yep.
great. So did anybody have any other questions on this illustration? Okay, I am just going to save this real quick because I'm assuming you're going to want me to send it to you.
Yep.
Create and preview reports. Okay, I'm just going to scoot this over here.
Somewhere that you put in the 65%, right?
Yep, it was a 65% illustration.
Okay.
So give me 1 second. Other 65%, 2,800 PM, 50K one time, 2-year spread. Okay, so I've saved that. Actually, I wanted to point out one thing because we're going to make a comparison in just 1 second. So at year 10, we have put in 33,600 times 8 plus 41,800 plus 41,800. So we put in $352,400.
Right.
In year 10, on the guaranteed side, we have $364,000 in guaranteed cash value. Okay. And that's just if he sticks to this plan. If he adds more money, that number will go up. But it adds, what was it, $8,200 a year of space into the policy for him. So coming back over here, so we said it was what, 16,400? We're going to divide this by 3.
Okay.
Oh, the other thing I wanted to point out is that we have just over $1 million of death benefit year 1. And in year 20, We have $2.4 million, which drops down to just under $2 million at age 63, which is when the term policy drops off. Just for future reference. So $5,500 of space if we're dividing it over 3 years. So we're going to go back here. We're going to go to riders. $5,500 years 1 through 3.
Mm-hmm.
It's going to think about it for a second. And now we can hit the at a glance button. Okay, perfect. So we've put the same amount of money in over 10 years. So $366,000. And what did I say it was before? 364, I think.
Huh? Yeah.
Yeah, 364.
or something.
So to spread it over 3 years, doing nothing else, we now have an extra $2,000 in cash value in year 10, but we put the same amount of money in. The question is, how much space does he actually want? And the death benefit does come down a little bit. We said it was just over $1 million. So I think it's like 60,000-ish difference in year 1.
Mhm.
In year 20, we're at 2.4, which was about the same, give or take. And in year 21, when the term rider drops off, we're still at 1.9. So it's very, very comparable. It's really, and that $2,000 is negligible. It's just a matter of how much space does he really want
Mhm.
and when does he need it? So because keeping in mind that for the first 3 years, he can't add anything else. It is fully maxed out.
Mhm.
But for years 4 through 10 in this illustration, he has a 5,500, I think, of extra space. Whereas in the other illustration, he's got $8,200 of extra space, years 3 through 10.
Mhm.
So it's, I'd have both illustrations ready and just say, these are the 2 options. And really what it boils down to is how much space do you need and when do you need it? What are you looking to accomplish? What do you think you're going to have for extraneous money that you want to save and grow in a guaranteed, predictable way?
Mhm.
Does that make sense?
Yep.
Okay. So again, I'm going to save this one because I assume you want me to send it to you. It's going to think about it forever and a day. Give me 1 second. Save as.
Yeah. Number one question when I talk about the, private banking planning or setup, and they were just like, "Hey, I'm gonna move $1 million into this," and obviously we can't. And I talked to Forrester. They say maximum is 200,000, and then spread it out in 5 years. And we have to go through all that stuff.
Okay, do these people have $1 million?
Yep.
Okay.
Yep. They have 2 million. Actually, the client has 2 million in stock.
In stocks.
Yeah.
Okay,
And,
which is taking a beating right now. How old are these people?
well, he's 62 or 63.
Is he looking for income?
But before the stock hit, actually, before the drop. So, but and then we can't find anything that I say like, oh, I want to move it all in here, and then how much I can take the money out.
Are they in California?
Yeah.
Um,
So how these I mean, I thought it just like one case, but it's become more and more like people keep asking me like, okay, so then I move this money into, and then I brought up some annuities that you need to put in there and then you take it out.
Because on somebody that's that age, putting together a bank is going to be difficult anyway. So you'd be putting the bank on their kids.
Mm-hmm.
How many kids do they have?
All his kid is grown, so, but I
But how
didn't,
many does he have?
I didn't really ask, but I assume probably at least he's married, so he said have maybe two.
Two kids?
Yeah.
Okay.
mhm.
Because in that case, you can find out about what the kid's situation is, because he now has the opportunity to create a multi-generational bank.
Mhm.
So he's putting up the premium. He can fund the banks to basically to their max that will be allowed by their children's income,
Mhm.
and then make all of the rest of the assets a little bit more sturdy. And you might want to talk to him about possibly a trust if he's
Mhm.
got that much in cash assets, uh, especially in California. Estate taxes are brutal.
Yeah.
So definitely talk to him about a trust. We can talk more about that offline. Give me a call.
Okay.
And set him up to be bulletproof. He's got a ton of money.
Right.
So, but he can take a chunk of that and create the bank on his kids and his kids' spouses. He could even set up, do his children have children at all?
Don't know, but I think they are in their 30 plus, so they should have.
If they're going to have kids, they have them already.
Mhm.
So, you can set up IULs on the children such
Mhm.
that you're funding $1 million baby projects on each of the grandchildren, so
Right.
that you're setting up this multi-generational system, whereas it's a major gift to his children and his grandchildren that he can benefit from during his lifetime. He has access to the cash value inside that policy, all of the policies, because he will own them during his lifetime. When he eventually expires, that ownership transfers to his children because the policies are on them. Does that
Mhm.
make sense?
Right.
So
Right.
now they can continue to have this bank and use it during their lifetime. When they eventually expire, the death benefit goes to the grandchildren,
Okay.
and the grandchildren will have been set up with their first policy. And assuming that they are under 18, it would have to be an IUL to really generate any sort of cash value. But if they're young kids, it has the time to grow.
Mm-hmm.
So also with the trust, it creates a bulletproof scenario that none of it is accessible outside of the estate.
Mm-hmm.
So, and it can pass from generation to generation without estate taxes if it's set up properly.
But your strategy is, first thing is like, yeah, he would just he came to me because of the tax. He said, oh my gosh, I have to pay a lot of tax because stocks that are these earning that's
Income tax, capital gains tax,
capital gain tax.
and he's in California. So, geez, and they call us Taxachusetts. So yeah, it's a real thing. So the first thing I would recommend is that he speak to a trust attorney.
Mhm.
And ICANN does have a relationship with a very good one. I'm not going to tell you that it's inexpensive. It's not. But when you've got a client who has $2 million in basically cash assets, which is, stocks can be easily converted to a cash position, you need to protect that. You also need to start talking to him about protecting those assets against loss.
Mhm.
So protecting them against tax, protecting them against market volatility, and protecting his family and the longevity of his family, and keeping all of those assets within the family. So trusts, life insurance, annuities, there's a lot there. And this is a multi-generational thing that he can set up.
Mm-hmm.
And, you know, if he's on board for it, you can get the kids involved in the conversation, because eventually they'll need to be involved in the conversation. And, you know, it's something that he could set his kids up to be financially set without, you know, just giving them everything. But it's something that he could live to see. He doesn't need to wait until he dies to
Right.
provide for his family. Does that make sense?
Mm-hmm.
Okay,
Yep.
so we've gotten very off topic at this point,
Okay.
but I think that was a very good discussion. So coming back here. So does that answer your question for what we were trying to do with your client building space with that
Okay,
bank?
so so one last one is when I ran on the Life Plan 360, it came out with the guaranteed growth at he want to retire 2045, so that was how old is he now? 60, 65 or 68. Let me see. He was 40. 2000. How old is he? 44?
He's 42 right now.
Oh, 42. So $42. So I try to calculate how old is he? 2045. That's when he want to retire.
So that's 23 years, so that's 65.
Okay, yeah, 65. So, and then at 65, let's say guaranteed growth is 1.2 mil. How we doing so far?
At 65,
Mm-hmm.
pretty darn close.
Okay.
So 1.187.
Mm-hmm. Okay. That's with dividend, right? And the guarantee is 1 mil.
Just over.
Mm-hmm.
Yeah,
Okay.
1 mil right there.
All right. Okay, good.
So, and that is that's with the $5,500 spread over 3 years.
Right. Okay.
It is darn close, and you can actually play with the death benefit percentages.
Mm-hmm.
So if you knocked it up to 70, you'd probably almost certainly get to the 1.2 over here.
Mm-hmm. Right.
So just food for thought.
I see. Uh-huh. So can you quickly where you put the 65? Because the way you do it is easy. Because the way I do it, I have to kind of like, okay, let's do 100 grand and see how so, and then slow it down, go down. Start with 100,000 life insurance and then run it and look at the number. And then
Okay, you're using a
I
different.
do all the calculation. Let's say 30, let's say 2,000 something, 800 a month. Then I have to go, okay, 65% is how much cash. And then,
Yeah, so that has
Well,
to
the
do
way
with the
you did-
solve that you're using.
yeah, the way you
So
did it. Like,
it's the FPUA permanent term blend non-MEC face solve that you want.
okay.
It simplifies the whole thing.
Okay, so you just put the number 65% there, and then it will kind of automatically calculate the
Yeah.
money, the premium.
Yeah, so if we go up to 70
So you use
here,
70,
go to at a glance. 65. That's actually not that big of a difference.
mm-hmm. Right.
Yeah.
And obviously as far as commission goes, 65% is more commission.
Yeah, it is.
They get the same result anyway, so right?
Yeah, it's literally like,
Mhm.
I think $2,000 difference in cash value, but it
Mhm.
is very, very close to what you've put into the Life Plan 360 software, and it's changed slightly because of some of the legal rules around creating illustrations. So it's a little tougher, but yeah, we're right on par here. We're really on target. And I mean, if it comes out at 1.18 or what do we have? 1.188 versus 1.2, like it's
Yeah,
$12,000.
1.201. Mhm.
Yeah, exactly. So it's at that point it's negligible.
Mhm.
So hopefully that's helpful.
Yeah, and obviously the guy is only for 42, but if the guy is 65, it's totally different. That amount will.
Right,
Yeah.
right. So your client who is already in their 60s,
Mhm.
they're gonna need some sort of life insurance on them anyway to be able to insure their children. There are ways around it. But it's going to be incredibly expensive if they don't already have insurance to
Mhm.
insure their children, or excuse me, if they don't already have insurance, it's going to be incredibly expensive to insure them because of their age. So building a bank, putting it on somebody in their 30s and 40s, i.e. their kids, it will be much more beneficial to the family unit as a whole. But
Mhm.
there are a lot of moving parts there. There are a number of conversations to have with the client. It seems like they are just, completely open, that they have complete exposure to everything that is financially detrimental, to taxes, to risk, to it doesn't sound like they're overly protected in terms of loss either. So there's a number of things that you could do for that client. So definitely, if you have other questions, feel free to reach out to me offline. But so I don't really have a whole lot of time to go over the other way to create space if you only have the monthly payment, because that'll take more than 10 minutes, which is what we have left. Does
Right.
anybody have any questions thus far? Because there is another topic that I wanted to talk about today that I could probably do fairly quickly. It is very brief, but I want to make sure that I have time for questions. Anybody? Okay, so I wanted to talk a little bit about what you do for a client when you can't do anything for a client. Has anybody had this happen? When you have a client who's sitting in front of you, who they make money, they are working, they do have an income, but maybe they don't have enough income right now. Maybe they're young, maybe they have a lot of debt, maybe they have a lot of things that could have gone wrong for them. Maybe their goal is lofty right now. So I actually sat down with a client earlier this week, and they want to buy a house. They want to buy a house like yesterday. And for those of us who live in very expensive states, that is a difficult thing. Give me 1 second. I just need to. Oops, there we go. Couldn't find my mouse. So for those of us who live in very expensive states, and probably even for those of us who don't live in very expensive states, we all know that the cost of housing is absolutely skyrocketing everywhere. And this is a major, major problem for young families who don't already have a house, who are currently renting. So what do you do for this person? Here's let me stop sharing real quick so that we can actually have a conversation. So what you do for these people is your level best. You give them knowledge, even if there's nothing you can do for them, even if you can't actually get them out of debt. You show them how to get out of debt. You talk about the buyback principle, the snowball principle. If anybody remembers what I'm talking, I'm actually going to share my screen again real quick. Share screen 3, share, bring up my calculator. So what you're going to do to figure out which debts to pay off first, and I've used this analogy before, you are purchasing cash flow. Does everybody understand what that means? Okay, so purchasing cash flow means that you're taking your monthly payment and you're dividing by the total debt. So let's say that they have a credit card that they are paying $200 a month and their total debt is $1,500 per month. Their debt to payment ratio is 13, or their payment to debt ratio is 13%. Okay. So now let's say that they have a car note, right? So their car note is $400 a month, but their total debt helps if $400 a month, but their total debt is $8,000. The payment is higher, right? Theoretically, we'd want to pay off the higher payments first, right? Anybody?
Mm-hmm.
Not necessarily. That debt to payment ratio, or payment to debt ratio rather, is 5%. So paying off that $1,500 credit card is going to buy them a lot more cash flow than paying off the $400 a month car payment.
Oh, I see. Okay.
Does that make sense to everybody?
Yeah.
So we're trying to show them how to purchase their cash flow. So we're taking that, what did I say it was, $200? We're taking that $200 a month, and now instead of paying $400 a month toward our car payment, now we're paying $600 a month toward that car payment to buy down the debt faster. So we're going to build them a plan. Just because they can't afford to have a Life Plan 360 or a Life Plan 360 Platinum plan right now does not mean that we cannot help them. We can give them financial education, which we can do for multiple reasons. One, if they actually follow the plan, they may become a client. Two, you don't know who they know. They might be living next door to millionaires. You never know this. So, especially if they live in a multifamily apartment house, their landlord might be a good client. So showing them how to do this, you're giving them information, you're giving them a reason to come back to you. And don't forget the power of Google, guys. So for example, I'm in Massachusetts and I literally just searched for Massachusetts first time home buyer help. I now have a whole slew of resources that I can give to this client to show them, what maybe they qualify for, what programs they maybe didn't know about. And to be able to give how long did it take me? I even scanned through some of these things and took me 5-10 minutes to come up with resources that are valuable to my client. Something else I might do for this client, because they have young kids, is we might do either an annual renewable term or like a 10-year term or something along that line, to preserve their insurability, because a lot of carriers allow you to roll over a term policy into a whole life at certain intervals throughout the term, and to make sure that no matter what happens, they are protected. But it is far less expensive for them to protect their family using a term policy that they can afford than trying to stuff them into a bank that they are not ready for. Does that make sense?
Yeah. So Kendra, I have a question. It's Cece. So
Yep.
you took that $400, that car payment, and then you have $200 Can you explain that again? I didn't grasp that.
Yeah. So we're going to say that this client has two debts, right? A
Mhm.
$200 a month car payment, or what did I say? A credit card payment.
Oh,
And it's $1,500 for the total debt. So if they paid it off right now, it would cost them $1,500. That's 13%. So they have a $400 car payment, but their total debt is $8,000 a month. That's a 5% debt. So when we're talking about purchasing cash flow, it is much more beneficial to them to commit $1,500 of capital to getting back $200 of cash flow than it is to commit $8,000 of capital to get back $400 of cash flow. So now they've paid off that credit card. They have an extra $200 of cash flow that they just bought. Okay. So we can now commit that $200 of cash flow to their $8,000 of debt. So now instead of paying $400 on the car, they can afford to spend $600 on the car to pay down that debt faster. Does that make sense?
Yes.
So if there is, let's say that a client has $20,000 of capital and they have $30,000 of debt. Okay, you can't pay all of that off.
Right.
So you're going to do the math to figure out which debts are going to purchase the most cash flow for the least capital.
And the cash flow is coming from the whole life policy, or?
Nope, the cash flow is coming from their payment to debt ratios. So
Okay.
these are dollars that they're already paying every month. They're paying $200 on that credit card every month. They are paying $400 on that car payment every month. So we just need to figure out how we can best utilize their cash flow to get rid of the debt the fastest.
Got it.
So that they then have that $600 of freed up cash flow to start saving with.
Understood.
So does that make sense?
Yes, definitely.
Okay, because we will come across a lot of people who are great candidates, but they're not ready.
Mm-hmm.
So we need to give them the tools to get them ready. And granted, these are people that I'm not going to spend a lot of time with. If I'm not getting paid for my time, I'm not going to spend 2 hours every month sitting with them, making sure that they're following the plan. They need to learn to have a little bit of self-discipline and be able to do that on their own. And if they have a question along the way, they can call me. But I'm not going to continually make appointment after appointment after appointment with somebody who is not making me money. Does that make sense?
Yes.
But I will set them up such that they can follow the plan that we set up. If they have questions, they can call me. And when they're ready to start saving, they can call me. I might check back in with them, keep dripping on them, make them part of my marketing pipeline. Just ring them up every 3 to 6 months. Say, how's things? How's it going? How's the plan? How are we doing with everything? Do you have any questions?
Mm-hmm.
But it's not something that I'm going to invest a lot of time in because it's not making me money, but it could.
Definitely.
And that's the point. So you don't want to look at these people and be like, well, there's nothing I can do for you. Set them up for success, but they have to take the ball and run with it. It's just like with, I've said this before, I'll say it again. I love you all dearly, but I can't want success for you more than you want it for yourself.
Mm-hmm.
So you kind of have to take the tools that I give you and take ownership of them, implement them in your own life. By all means, if you have questions, call me, reach out, email me. I'm happy to help you guys be successful. But I can't want it for you more than you want it for yourself. It's the same thing with a client. You can't want it for them more than they want it for themselves. So give them the tools to be successful and let them run with it until they are actually making you money in some way. And if you have a system that you're charging them like $50 or $100 for an appointment and that works and they continually come back for appointments, you know they're committed. Put time into that client. But does this make sense to anybody?
Yes,
Mhm.
100.
Okay. So yeah, so you want to put the most time into something that's getting the most value. And it's the same with the payment to debt ratio. You want to put the most capital into what is buying you the most benefit. It's the same thing. It's always about principal to benefit ratio. What is it costing you to get the benefit? So, and that is a rule that applies to everything. You have to figure out what the investment versus the ROI is, return on investment. Okay, so we're a little bit past the top of the hour, and I want to be mindful of everybody's time. Does anybody have any last minute questions before we adjourn for the day?
Yeah, I have one more, for the PDF, Kendra.
Yep.
So right now, how much the interest they give for the set up the PDF account?
I want to say it's circa 1%. Don't quote me on that. It should be somewhere on the Forester's website. I haven't checked it in a couple months.
Okay, for Forester, right? Around 1%. Okay.
Yeah.
And then how easy it is. So when they open, let's say they open the policy and they say
Yep.
this is now going to the PDF, and then it's the same application on a live application or a separate application.
It is a separate thing, but it happens at the funding phase.
Okay.
So what you're applying for is the death benefit. So
Okay.
when you get to the delivery and the funding phase, you have a separate form to fill out. It's fairly simple. It's like 4 or 6 pages, something like that. And you fill out the client's name, the policy number, all of their EFT information so that it's direct debit, how often they want to have those direct debits made. To have the PDF, it does have to be an annual premium payment, but they can still pay into the PDF on either a quarterly, bi-monthly, monthly basis, however they want to set that up.
Mhm.
And the PDF is also on that form. We're depositing X number of dollars into the PDF right now, and this is how I want those payments to come out of the PDF and into the policy.
Mhm.
So it's all a separate form, but you don't have to specifically worry about that on the initial application. You want to make sure that your illustration is correct because you want to get the underwriting done correctly. And if the risk class changes, you'll have to update the illustration. Again, not a huge big deal. They'll walk you through that if and when that happens. And you can always reach out to me if you have trouble with it. And we'll get those questions answered, sorted, and get the business underwritten, closed, delivered. And it's at the delivery that the PDF gets set up, and then the policy gets funded, the PDF gets funded, everything is copacetic, and congratulations, your client now has their first bank.
Okay. All right. Thank you.
And I have a question, Kendra.
Yeah.
And so you're saying that, so with the PDF being funded with a lump sum, and then you were saying that that's going to automatically make that an annual payment from the PDF into the policy, but the client can actually still have monthly payments that are going into the PDF.
Yep.
It's going into the PDF, and then so subsequent to the first 2 years, all additional payments are going to go through the PDF to
Yes.
the policy?
Yes.
Oh, okay.
Yes, so that's why the formula is the way I have set it up. So that the PDF is never overfunded to the point where they can't add more money into it. So I subtract out, you take your lump sum, you subtract your first year premium, and then you divide by 3, because you can have a total of 2 years of premium in the PDF at any given time. So by taking that first year premium out of the lump sum, that allows you from month 1 to start paying monthly back into the PDF, because at the end of year 1, the PDF should be max funded at that point because it will have 2 years of premium in it. But on the anniversary, the policy will pull a chunk of money for year 2 from the PDF into the policy, and the client can continually pay on a monthly basis, refilling the PDF. So year 3 on the anniversary, it pulls the chunk of money into the policy. So now that lump sum is gone, but the client can continually pay monthly and the policy will pay annually, and it does not affect their lifestyle, budget, what have you, one iota. And if they have a little bit of extra money that they feel that they would like to add into their policy, they can do that. They can either put it in the PDF and wait for the annual premium, or at the annual premium time, they can add it in. They have options. Does that make sense? Did that answer your question?
Absolutely. Thank you.
Okay.
Mhm. Yeah.
So sorry, go ahead.
Oh, yeah, I just want to quickly add to this, because the reason that we're doing Life Plan 360 is we promise the client that they won't change, their lifestyle.
Right.
So they do what they do, and they spend, whatever they're spending right now, and they just come to us and we solve the problem without changing, like say, hey, you gotta, like Dave Ramsey, hey, you gotta eat rice and beans, and you have to stop going out and eat for 6 months, and all that stuff. So that's where their interest. So keep in mind that we don't want to ask, hey, you gotta put more money in, or you gotta
They don't
stop.
have to. They don't
Yeah.
have to.
So
They
that's
can.
Mhm.
They don't have to.
But if they can do that, that even more,
Right. Right.
benefit.
I mean, it's important for them to understand that they can,
Mhm,
but it's equally important for them to understand that they don't have to.
mhm. Yep.
So if they're, oh, all of a sudden I got a $10,000 bonus at work, or a $50,000 I don't know, inheritance from an uncle I didn't know about. What do I do with it? Okay, great. Let's take a look at your policy. Let's see if you have space. Let's talk about your options. Let's talk about what you need, what you want, what your goals are. Sit down and have a conversation with them.
Mhm. Yep. That's
There's plenty of things that can be done. And it's about having that ongoing conversation and making sure that your clients feel that you are a resource for them, because you don't want them to feel like, oh, well, this was just a sales transaction, and now that I have this, I'm on my own, because that is how you lose a lot of referral business. But if they feel that they can come to you every time that they have a financial scenario, they'll bring friends. You will make money.
Yep.
Money makes money when money moves.
Mm.
So, all
Nice.
right. I just want to be mindful of everybody's time. It is about 10 past. Is there anything else I can help you guys with before we adjourn for the day?
That's it for me for now.
Okay, great. Well, have a great weekend. Andrew, I cannot remember your email.
Okay, I'll send you.
Yeah, send me an email. And
Mhm.
I'll just respond to that with the two illustrations that we looked at today.
Mhm. Okay.
All right.
All right. Thank you.
All right. Have a great day, guys.
Um,
Bye.